So in Islamic finance, this is the most common concept known in terms of impermissibility. But do you really know what riba is and the different types of riba that can exist? In this video, I'm covering 3 things to answer those questions. Number 1, what is riba? Number 2, why it's not allowed? And number 3, I'll also be going through examples which don't appear as riba but are classified as riba in Islamic finance so that you're aware of what to steer clear from. One of the most important rules of Islamic finance is the prohibition of riba, which is absolute and unqualified. Any business agreement which includes an element of riba is invalid from the Sharia point of view, even if the parties agree on the terms of the contract. Riba is often translated by the term interest, but its literal meaning is excess. And in Islamic finance, it's defined as any excess compensation without due consideration. Now, people often forget the rules of Islamic finance aren't about the individual. We can always say that yes, riba is bad, we can see the negative impacts of it, but if I budget correctly and manage my finances, I can take some riba without it causing me any harm. But the rules of Islamic finance are for society, meaning they're more important than the individual's viewpoint and situation. Because even if we can manage certain amounts of payments with riba without any issues, the people that can't, we have to interact with them and they have to interact with us as well. Consequently, society breaks down. You see that divergence between debt and wealth allows debt to grow at a higher pace than wealth, resulting in what is often referred to as an inverted debt pyramid, the situation in which increasing amounts of debt are needed to be serviced by a shrinking base of wealth and income. And the income required to pay the debt does not grow at the same rate as the debt, and thus the system becomes unsustainable. In Islam, debt is allowed, but financing and real economic activity cannot be disconnected, and wealth creation and debt creation must take place simultaneously and at the same pace. As a consequence, Islamic financial instruments that have a debt element to them need to be associated with the ownership of an asset or service. Examples of this can include an Islamic mortgage, leasing a car, or seeking funding for business growth. If you want me to drill down on any one of those in a dedicated video, then drop a comment down below and I'll look into doing that. But those 3 examples, when signing an agreement that's valid under Sharia principles, have to have an ownership of an asset in them, unlike conventional finance where you're just given a loan and the lender just expects to receive interest without having any ownership in the activity. Now, to fully grasp riba and where it's applied, it's important to understand what the difference between a loan and a trade is. A loan involves the exchange of 2 items identical in quality and nature, but with a potentially unequal value or quantity. For example, money now for money in the future. A sale, on the contrary, is an exchange of 2 items that are different in quality and nature, such as money for food. In other words, the defining feature of a loan is the quality of the 2 sides of the exchange. If the quality is identical, then the transaction is characterized as a loan. In the event that they differ, then the transaction is characterized as trade. A good illustration of this difference is from one of my previous Islamic finance textbooks, which breaks this definition down via a simple tree diagram. So the next section of this video I want to cover is why is riba prohibition so important? See, trade fosters economic growth and encourages specialization, which is essential for wealth creation. Different people have different tastes, abilities, gifts, skills, and experience. By allowing all participants to focus on their speciality, they can provide high-quality goods or services which they can then sell to others. Specialization enables each person to produce better quality and larger quantities of their product or service. However, the economy and the individuals only benefit in the form of increasing wealth and prosperity if there is a market to trade the products and services. A loan contract, on the contrary, involves, as mentioned, the exchange of identical items and does not directly provide any incentive for specialization and doesn't create any wealth. It ends up with an unequal balance of who's benefiting from trade as risk becomes one-sided and the people that hold wealth keep collecting more wealth without any care for any innovation or economic growth. There are several methods within Islamic finance where deferred payments, essentially a loan, can be provided legitimately without going against any of the principles of Islamic finance. And to give them their respective credit, each deserves their own video to fully explain how they are structured and why they are permissible in Islamic finance. But the point to make in this video is that Islamic finance recognizes sometimes you will need money upfront from someone else to do certain tasks, and there are procedures in place that allow this kind of transaction. But for you and me, in terms of understanding what Muslims need to be aware of in avoiding riba, there are 3 types that you should know about. Number 1 is simple interest, or riba al-nasiyah. This applies to any loan of any type, including money. Scholars are in agreement that any stipulated addition on a loan, whether a loan of money or goods, is riba. Number 2 is compound interest, or riba al-jahiliyah. Compound interest is interest on unpaid interest and occurs when a loan is extended beyond its original maturity date without any repayment. For example, a borrower has a loan of $1,000 at interest of 5% for 1 year. At maturity, he doesn't pay the debt back, but agrees with the lender to reschedule the payment for 1 year at an additional 5%. Effectively, the lender is lending the borrower a loan of $1,050 at 5% to pay off the previous debt. The result is a much higher debt, and we can see here that simple interest ends up leading to compound interest. Number 3 is sale-based riba, and this type of riba is associated with what are known as the ribawi commodities, namely gold, silver, wheat, barley, dates, and salt. But it extends to a lot of other items in the modern day. Ribawi commodities are explicitly stated in the following hadith: gold for gold, silver for silver, wheat for wheat, barley for barley, dates for dates, salt for salt, hand in hand, like for like, in equal amounts. If these species differ, then sell as you like, as long as it's from hand to hand, meaning immediate transaction and settlement. The essence of this statement is, if these items differ, then sell as you like, and riba will only occur if it involves the exchange of 2 identical or similar items. Where the items are the same, for example, gold for gold, then the requirement should be immediate transaction and the quantity must be the same, otherwise there will be riba. You can also be in a situation where 2 items are not identical but similar, such as gold and silver, as both can be used as a form of money. Here the exchange must once again be immediate, but the quantity can differ. Where the items are completely different, such as gold and wheat, this is considered trade and there's minimum restrictions associated here. So lending on identical goods with additional stipulations we've understood to be riba. However, it's not always clear cut, and it's important to mention some of the controversial types of trades that can occur. Bayana is an arrangement in which 2 legitimate sales contracts are used to arrive at an illegitimate outcome involving riba. The structure of this example is as follows. A buys a mobile phone for immediate delivery from B for a deferred price of $1,000 to be paid in 6 months. Now that A owns and possesses the mobile phone, he sells it back to B for a cash price of $950. The final outcome of these 2 steps combined is that A obtains $950 cash from B and has to pay $1,000 in 6 months' time. The end result is simply a loan with stipulated addition from B to A, which sounds a lot like riba. This is a controversial practice, but I'm not saying this is impermissible in Islamic finance. There are scholars who have deemed this as allowed because of one important facet of Islamic finance. Whenever there is an action by a Muslim, there are 2 dimensions through which Sharia rules are judged on. Number 1 is the judicial dimension, and number 2 is the moral dimension. Therefore, unless the 2 parties explicitly stated that their objective is to exchange money now for more money in the future, people cannot be prohibited from making this type of contract. This is why the moral dimension is important in Islam. Transparency and ethics are an integral part of the Islamic finance discourse and govern what you can and can't do. Another controversial topic is by wafa. A sells a good to B for a cash price, with A having the right to cancel the sale, return the money, and receive the asset back. The right to cancel is a legitimate option in a sale transaction, which gives the holder the right to unwind the sale transaction and return to the position prior to executing the transaction. The right to cancel can, however, also be used in a manner that creates an illegitimate outcome, in this case, a loan with interest, because this example can be viewed as the 2 parties agreeing that A will lend B an amount of money equal to the cash price of the good. The interest on the loan will be the benefits derived from utilizing good during the loan period. Again, this is a controversial method which is allowed by some and not allowed by others. There's a lot more to Islamic finance, and I can understand that it can be confusing at times, but I've made a video on the main concepts that you should know for Islamic finance, which I'll link next to me, so go check that out, and I'll see you all in the next video.